Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. So in today's video, we'll be looking at why sitting out is the best trade. So basically in this video, I'll be discussing when not to trade, right? So we have seen a lot of videos about when to trade, what kind of trades to take, how to select stocks, and what kind of scanners to use, and bunch of those kind of videos, right? And there are a lot of posts about on Twitter about that as well, but very few people talk about the actually when you should not be trading, why sitting out is actually best at certain times, right? So basically I'm going to discuss that in this video, and I'm going to show you how you can decide that it's time to go in or it's time to sit out, right? So let's get started with the video. Disclaimer: this video is only for educational purpose. I'm not a SEBI registered analyst, and any stock discussed here is not a buy or sell recommendation. Please consult your financial advisor before taking any trade or making any investment. So there are two things: knowing when to trade and knowing when not to trade. So knowing when not to trade is more important than knowing when to trade. So basically what I mean is that there are times in the market where you should be going aggressive, and there are times in the market where you should be going a little cautious. Your approach should be little cautious, right? You shouldn't be going you shouldn't be fully invested, or times like that. So knowing those times when you have to sit out, especially for the short term, the swing traders or the short term traders, right? So it is actually really important to understand those times, that when you should sit out. So let's start with the big picture. So trading isn't just about finding the perfect momentum to buy or sell, it's also about knowing when not to pull the trigger. Sitting out of the market can save you from unnecessary risk, emotional decisions, and ultimately from losing money. So time is not right, when the time is not right in the market, you'll be making too many unnecessary decisions, you'll be taking too many unnecessary trades, and that will ultimately lead to the losing money, right? So one thing that you have to accept is that trading is also a lot about chance or luck, right? So there are times when you will be making money like blindly. You can just uh, you know you can just throw the dart anywhere, pick up any stock, and it would be going up, right? So those are the easiest times. And then there are times where no matter how good of a trader you are, no matter how good your technical knowledge is, you won't be making any money because the market is not supporting you. So in the end, the support of the market is actually really necessary. Although it's not like you can't make money in the current scenario, or that you just need to alter your approach. But I'm talking from a more of a beginner perspective, and from the general perspective as well, is that you need the market environment behind you to make, in order to make money, and especially if you want to make big amount of money, right? Because trading in today's time is like hunting for peanuts, right? You'll be getting small profits. So if you're satisfied with that, if that satisfies your need to trade, that is okay. But usually what will happen in most cases, that you will keep on trying, but if the market is not with you, it will not work, and ultimately you will lose money, right? So the most important question is when to sit out, right? So that is basically the whole point of this video as well. So sitting out generally depends on many factors. The first and the foremost being your trades not working, right? So there are bunch of ways you can quantify it, right? So first and foremost being your trades not working, right? So there are mainly three four methods, right? Mainly four methods that you can use to look at to actually quantify the time when to sit out. So the first being your trades hitting stop losses more often, right? So that is the first indication, is that you're taking a trade and it's quickly hitting your stop loss, and that is happening more often, right? So again, that is a clear sign that there's weakness in the market. Second is number of stocks in your watch list continuously decreasing, right? So if you are a disciplined trader, you must be making watch lists every single day, or maybe at least every single week, right? So one thing that you'll notice is that when a lot of stocks are breaking out, when the market environment is too good and a lot of stocks are breaking out, you'll see you'll be getting too many names in your watch list. You'll get too many names, right? So you'll find this stock, that stock, like almost all of the stocks are ready to break out and they're ready to move, right? But when actually the market environment, goes bad, that is the time where the number of stocks in the watch list will start decreasing. Third one being market breadth sheet. So again, we all have a market breadth sheet, and if you don't, I have actually made a video on this. I'll keep the link in description and on the I button, right? So market breadth sheet will also tell you about the market strength, if the market overall market strength is there or not. And the second and the last point is the broader market participation. So one thing that you must have noticed is that when the times are good, when the market is going up, when there's a bull run, you'll see majority of the sectors will perform, right? So sectoral rotation keeps on happening. The sometimes the one sector is moving ahead of the other sectors, and then it will be taken over by another sector, and that way it keeps on happening again and again. But generally you will see that most of the sectors, not all, but most of the sectors are moving in a similar direction, right? If there's a bull market, most of the sectors will be going up, and there's a broader market participations. The IT will be performing, pharma will be performing, metals will be performing, banks will be performing, right? So it's not like all of them will be outperforming, but generally you will see that most of the sectors are performing really well. But when the market goes bad, you'll see there's no broader market participation. Most of the sectors have started coming down, and there are only bunch of sectors, only few sectors that are currently performing in that particular market scenario, and that could be due to fundamental reasons or maybe because of other reasons, right? So like there's a saying that there's always a bull market somewhere, so that would be the case in case of these particular sectors which will be performing in a bad market as well. But that is actually a kind of difficult to identify. Plus, even if you identify, the broader market participation will again have some weight on that. If the overall market is not good, even in that sector you won't be able to trade peacefully, right? So trading peacefully, if you want to know what trading peacefully is, you just look at the charts of the 2023 or the 2021 time period. You'll see what trading peacefully is like. So I've prepared a few examples from the current market scenario, and I'll show you why the market is currently not doing good, like it is time to sit out. So here, if you see, the stock had a really nice setup. So this was a kind of false breakout that happened, and after that the stock went in consolidation, and that too above the moving averages, and then there was a very strong breakout. If you see, the volume also picked up a bit, and there was a follow-up as well next day. But if you see what happened after that, there was a very strong selling, that too with high amount of volume just after 2 days. So in a very nice market, in a good market, generally it is not the case that the selling comes just after 2 days. In a good market scenario, what you'll get is that you'll get a swing moves of few days, few weeks, and even for few months as well, right? So here the stock breaks out, but there's no proper follow-up, and it just peaks out just 2 days after the breakout. I have another example. So this one here is that stock broke out from the range, consolidates for a few days, but there's no follow-up. Instead, the entire moves fizzle out. So again, this is from a sector that is actually doing really good. So if you see, pharma sector has been relatively outperforming if you look at the as compared to the overall market, but that too in very few pockets, right? So again, this broke out from the range, and there was few days consolidation. That is quite normal. That is like the quite normal kind of price action. But there was no follow-up, and the price actually fell down, right? Another example. So here, this one again, it tried again and again, tried breaking out, reversing every single time from the 10-day moving average or the 21-day moving average, but there is no follow-up. So even though this particular stock is trying to show some strength, there are no buyers to carry it. That means there's a lack of buying strength in the overall market. Like nobody is interested it to take to take it higher. That again tells you about the market environment not being good. Another example, this one was actually consolidated from a month. There's a very strong shakeout as well. There was a very nice breakout with very high volume, but the breakout failed. Just look at the 2 days activity after that, right? So in this environment, what is the problem with this particular environment is that we have a certain type of trading method that is set. We have a certain type of trading type, we have a certain type of trading method. So basically a breakout trader or a swing trader, what he will do is that he will buy at the breakout, he'll keep a stop loss somewhere at the low of that particular breakout, or somewhere near his buy point, etc. And what he does is that he generally waits for the stock to move higher, and then he can shift his stop loss up, and then he'll follow the trend and all of that. But in this scenario, what will happen is that you're getting stocks like this which are breaking out, but they are hitting the stop loss just after 2 3 days. So what does that create? That just simply means bunch of your trades are failing, and although your loss may be small, but if you continuously keep on doing multiple small losses, that will accumulate to be a big loss as well. Plus there are charges and many other things that again is a very disadvantaged position. So the basic difference you'll see in a good market and a bad market is that, let's suppose you have 10 stocks which are ready for a breakout or which are looking really good. So in a good market scenario, 6 or 7 of them will break out, and the chances that you will be holding 1 or 2 of them. But in a bad scenario, what will happen? Out of 10, only 2 or 3 stocks will actually break out, will actually move, that too not very clearly. And there's a very last chance that you might be holding that 1 or 2 name, right? So that is the issue. Very small losses keep on accumulating, like this one. Just look at the example of this one. So this was a very popular stock on Twitter recently, because again, why not? It gave a really nice large base breakout. There was a triple digit EPS growth and everything was perfect, and the breakout itself was very perfect. But what happened after that? It failed, right? So again, you're hitting the stop loss here, you're losing maybe 0.1% of the capital, maybe 0.5% of the capital. But if bunch of trades go wrong, then you're actually losing a significant part of your capital as well. Plus there's many other issues with that. The especially it's very frustrating to do multiple losses, like to have multiple losses. It's actually really frustrating, and it also blurs your decision making. So best scenario is that you can either shift to a very short term trading type. You can alter your approach. You can start day trading. Again, that requires some experience, especially not for the beginners. You can change the asset, you can try to go with the commodities, right? So that is one method. But usually for the most people, the best method here would be to just simply sit out, wait for the market to give you a signal, right? And how to quantify that, like simply how to look at that. Okay, so just like if we want to see, just look at that, how we can quantify it if the market is good and not, right? One simple thing that you can see, as I said, the number of stocks in the watch list, right? So in this watch list that you can see, this is my main watch list, that is the actionable watch list. So usually there are many names, like it, like in a good environment, I'm getting like 60 100, like 60 70, even 80 100 names which are actually looking really good. But currently you will see the number of stocks are down to 20. That too, very few of them are actually good at this point, right? So if you see NBCC again failed to move up, right? So again, not a really good setup. And actually the number of stocks have decreased. So if you remember my last video, we selected somewhere around 30 27 30 names, and 10 of those I have removed because again they failed to move up and they actually moved down, right? So most of them, if you see, look at Chambal Fertilizers as well. So this was a really nice setup. You see a big base forming here, but there was a no follow-up move, there was no breakout, and actually went in the opposite direction, right? So it hasn't broken 50, so I have kept it in the watch list to see if it bounces back or not, right? Second thing you'll see is that most of the sectors which are performing really good, like the railways, defense, and all of them, one thing you'll see is that just look at the charts of those sectors. So they peaked out at least a month ago, right? So they peaked out in July, and since then they have been in a downtrend kind of a situation, right? So these were the sectors that were actually really, top performing sectors. You see most of them, just look at the charts of most of these names, right? They are all in a downtrend. If you see railways, So in many railways railway names, you'll see the entire up move that they had before July, that is completely faded, right? So, and you see, many people actually bought them somewhere around here. So if they have had the stop loss, then they would have easily, would have easily gotten out. But if you're not trading with the stop loss, then that is definitely a disaster situation for you. You look at Railtel. So this was a very popular one. There was a very nice big base breakout. There was a inside bar breakout, and but what happened after that? There's no follow up, right? So the best performing sectors are coming down, right? So oil and gas was a sector which was picking up strength, but if you see from last 2 3 weeks, it hasn't been doing really that well. And this was the sector that was picking up strength. Look at IOC, right? You look at Reliance, you look at MRPL, all of them showing weakness. And even if you look at just the indices as well, you see micro cap, mid cap, and the Nifty and the small cap, all of them making making a similar setup. That is, they are kind of forming a a head and shoulder kind of a situation, and they are currently taking support at the 50-day moving average and struggling to fill this gap region. So as long as this is not filled, so that is, at least till then, I'll be staying out unless some very tempting opportunity comes in, right? And most of them are ready for a breakdown. So I'm not predicting that the breakdown will happen, but there's a very high chance, especially as long as this gap region is not filled, because again, there's too much supply there. You look at other sectors, you look at pharma, which is one of the outperformers currently. But if you look at other sectors like auto, CPSC sector, commodities, if you look at the PSU sector, energy sector, most of them are currently kind of a weaker side. If you see financial services, especially auto, looking for a breakdown after a very very nice bull run. So this is time to be cautious. And plus, the last thing that you can check is the market depth. So what you can do here is that, first of all, checking the number of stocks above the 4% mark, right? So the lower the number of stocks above 4% mark, that simply means, and plus if it's too choppy, like someday it's going down to 29 and someday it's going up to 400, so that is again not a really good sign. Another thing that you can check is the number of new 52 weeks high. So in a very good environment, you can clearly see in a very good environment, the number of stocks that were making new 52-week high was quite high, above 50, 60, 70, 80. But currently, if you see, the number has gone down to very low, below 50. And the number of stocks making 52-week low has increased. Plus, if you look at the overall trend, the stocks above the 21-day, 50-day, 200, it is continuously declining. In a good environment, what you will observe, especially, you don't have to look at the 20-day moving average, stocks above 20-day moving average for a proper trend identification. But what you will see is that the number of stocks above the 200-day is continuously increasing. So from where we started in March 2023, and there was the bull run, and the number will stay well above the 80% or marks or so, and it will be quite linear. But if you see, it has gone very very choppy and it is currently coming down. So again, that is a time that you should be staying out of the market. Rest, your watch list will tell you, your trades will tell you if it's the time to move back in the market or not. Rest, you can alter your approach. You can try to look for breakouts on a intraday basis, right? You can just look at for the stocks which gave very nice move on intraday, like this one time techno, and just get out on that day. But that again requires you to alter your approach, right? Which is quite difficult, especially for the beginners, right? So that is it for today's video. Why sitting out of the market is the best trade. Goodbye, take care, and I'll see you in the